man, it's time to do another Q&A video.
Hey everyone, Ryan Bolton here, local mortgage expert, ryanbolton.com. I'm here to answer any questions you have about real estate, mortgage questions. I love doing these Q&A sessions. If you're looking for a loan in Utah or Nevada, I'd love to earn your business. I really enjoy what I do for a living. But let's just jump into some questions here. I love answering these questions. I get a whole bunch of them submitted, and I just like to try to compile them up and answer as many as I can. So usually I try to go through about 20 minutes worth. So let's see how many we can do. The first one, are there any fees or penalties associated with paying off your home loan early? Mostly no. There was loans in the past, most of them are gone now, had what was called a prepayment penalty. This would be a penalty if you try to pay off the loan early within the first 3 to 5 years. Most of those have gone away. In fact, there's even regulation that prohibits adding a prepayment penalty to the loan. So most likely no. There might be some loans that still float around out there that have that prepayment penalty, but they're really rare. So on the note that you signed, it's black and white. It'll say whether there is some sort of penalty for paying off the loan early. But I would say they're so rare that the answer is virtually no. There might be one or two still out there, but almost every loan says you don't have to do that. Now, however, if you do a loan, you want to keep it at least 6 payments as the way you bought the loan, whether it's a primary residence, second home, before you refinance. Now, you can add a second mortgage or anything like that, but most lenders have what's called a recapture fee, that they don't service that loan at least for this first 6 months. The loan officer, the mortgage company, has to buy that loan back because most likely it wasn't done at the intention of the loan. They didn't service it long enough. So that is one thing. If you get a home, keep it 6 months, then you can change the occupancy use, all those types of things. But technically, there is no prepayment penalty. You can pay it off or sell it or do whatever you want right after you do the loan. All right, let's see what else we got here. Let me find my list again. Let's see. Can someone whose home is for sale apply for a new loan at other banks as well? Yes. So if you're in the process of selling your home and you want to get pre-approved for the next home, I highly recommend that. It's something where, yes, you don't have to use that same bank. You don't have to use that same loan. It's something where, when you think about it, most of the loans get sold anyway. Most likely the lender you're paying today wasn't the lender that originally did the loan. These loans get securitized. They get pooled up in securities with Fannie Mae and Freddie Mac, and investors get bought and sold all the time. Money moves around. In fact, the more it moves, the better. If money is just sitting still, it's not doing anybody any good. So they want to be able to move that, churn it, reloan it, pay it off, use it, pay it off, use it. That's just how money works. So most likely, the lender you currently have isn't the lender that you started with. It was sold, or the loan was sold to a different servicer, but you don't have to use that lender. You can apply for another loan while you're trying to sell your home. You can even do what's called a bridge loan. This is where you can take some of the equity from the home you're in and use it for the down payment on the next home. I can help you with those loans as well. The nice thing with that is it gives you kind of the flexibility of pulling out the money to make both payments while you're transitioning, maybe do improvements, maybe be able to just get moved out, cleaned up, kind of fully transition to your new home while you're trying to sell the other one. I have so many times where people are trying to close in the same day on the one home, move in. Boy, what a stressful weekend that is trying to move out of one house, move into the other house while another buyer's trying to move in. I tell you what, some of the stress that people put themselves under for really no reason to maybe just save a few bucks sometimes really isn't worth it. So take a look at a bridge loan. This is where you can tap into some of that equity, use it for the down payment, or even pay cash for the next house, then move, get settled, go through the experience, enjoy the experience, and then sell the home you're vacating. So that's really the best way I would say to do it if you have the opportunity. Let's see. Are you prepared to make repairs or renovate? Let's see. Are you prepared to make repairs or renovations to your new home? Well, okay. Let's see. What are the benefits of refinancing your home and taking out equity? What are the benefits of paying down your mortgage faster? So the benefits of refinancing your home to take out equity, it really comes down to where the money's going. If you're using it to pay off other debts, it makes a ton of sense because you can free up that money to then put back towards a loan or free up for investments or savings or retirement. I think that if you're doing that, you really want to do something with the savings. Because if you pay off a car loan, a lot of people say, well, I don't want to put a car loan on a 30-year mortgage. You really don't have to. It's more about the cash flow. If you have an $800 car payment or a $500 car payment and you put that towards the mortgage, how much faster did that pay off? So let's say you have a total budget of $2,000 for the house and $500 for the car. What if you're able to put $2,500 towards the mortgage? You'll be able to pay that off so much faster and accelerate that so much more than if you have the two different loans. The other thing you can look at is increasing your savings. I think that's the better way to go, is if you're going to save and get rid of a bunch of other debts and credit cards and all these types of things, first, tear the darn things up. But second, increase it, retirement savings, those types of things. So 10 years down the road, you're in a much better financial situation. Not only have you built up all the equity in the home, but now you've got some money in reserve as well. So what are the benefits of refinancing? Obviously to save money, but do something with the savings. Do something with the benefit here. The second part is what are the benefits of paying down the mortgage faster? Just paying less interest, paying off the home that much faster. By freeing up the money on other debts and putting it towards the new loan, you'll just be more ahead of the ball game, more equity if you go to sell, just those types of things. But honestly, I wouldn't accelerate the mortgage as fast as accelerate savings, retirement, emergency funds. Get that first, then start to accelerate the mortgage, because you can't get to your equity without selling or refinancing the home. So if you're putting all your pennies, just everything you can to get that mortgage paid off as quickly as you can. Let's say you spend just 15 years, 10 years, just putting everything towards the mortgage. It's paid off great. Well, then what happens if you lose your job? What happens if you run into medical situations? What if you cannot do a loan to pull out the equity? Or what if interest rates on mortgages go way up? Now all of a sudden you got all this equity, you can't even get to it. Where if you do a combination of paying down the loan and building up savings, now you have a fund or money to tap into for retirement, emergency. You won't need other loans again. We talk about diversification in investment all the time. Like you wouldn't take $100,000 and put it on one gold bar or one stock. They always say you want to diversify, but we don't do it with real estate as much. We don't do it with, I want to pay off my mortgage as quick as I can. Now, I can't tell you how many times I've had clients that have struggled, put every penny they could so they could retire, and then they enjoy a free and clear house for 4 years, and that's it. But they took all those years to get up to that point, and they have nothing in the bank to show for it. They can't enjoy the golden years because they have a free and clear house, and they just get rid of their mortgage payment. So there's more of a financial plan that you want to put in place as part of your mortgage, and not just trying to take every penny you have to pay off the loan. Do a hybrid. Pay extra. Yes, pay extra, round up the payment, do what you can to pay off the mortgage, but take the $200-300 you're going to put towards the mortgage, get it in investments, get it in savings, get it somewhere else that's earning a better rate of return than just paying off the mortgage. Then you'll have access to it when you need it, and you won't need to rely on credit or income or job or other things to tap into the equity of your home, or you won't be forced to sell the property to get the equity. So there's just better ways to do it. All right, what else we got here? Got on a little soapbox there, but I see people do it all the time. I really do. There's just better ways to use the money. Build up savings first. Okay. All right, hold on. Let me get to the right screen here. Let's see. What are common problems associated with owning a home that people don't think about before they buy one? So I would say there's more expenses sometimes with a home because usually you're bigger square footage. So you're going to have maybe bigger utilities. You're going to have bigger insurance. You're going to have maybe more things that can break. But I would tell you, I've owned many, many, many homes, and they come in waves when things break. You can get warranties and stuff like that. But generally, these things are built so well that, I mean, like fridges and microwaves and stuff. I mean, when was the last time you had a rental property and something really broke, like the water heater or something like that? Now, this stuff does break, and usually it's a little bit more expensive because it's bigger. You know, you've got a full air conditioning system. You've got things like that. So that's some of the things that people need to be aware of, is there is things that do break, and you have to pay for it when you own the home. When you're just renting and the garbage disposal breaks, you just call the landlord and they fix it. But I ask yourself, if you've been renting for 2 or 3 years, when was the last time the landlord really had to fix anything major? And it probably wasn't even that much to really do it if you spread it out over 4 or 5 years, you know, that kind of thing. So, that's there's so much more benefit to owning a home. You have your own space. You usually have more room to a yard. You can have pets. You can customize it. You can paint the wall. You can move stuff around. You can put things on the walls. You can change out the kitchen. You can change out the bathroom. You can have a garage. You know, there's just so many more things that you can get by owning a home that you just can't with a rental. Like, why would you do anything to improve the rental property? Yeah, a home. Yeah. You know, I want this kitchen to be better. I want to upgrade the fridge, or I want to there's just benefits to owning a home that are above just financial as well. There's a pride of owning a home. There's a sense of accomplishment. There's a sense of community. There's a sense of neighborly that you just get to know your neighbors a little better because it's a little more long term. You're there for usually a little more for the long run. You tie into the community a little bit better. You're less likely to miss work because you've got just kind of, there's so many things that tie into home ownership, and that's why it's so emphasized. That's why it's so encouraged, and that's why it's financing is available and investments are available and government loans are available because there is something about owning a home that's just amazing. All right, what else we got here? Let's see. Why do people buy and sell homes for profit? Why wouldn't you? I mean, they're great investments. I mean, they have, like a stock, if you have to basically buy that entire stock in most cases. Where a home, you can put 3% down. You can put 5% down and own the entire thing. You can debt service with rental. You can improve it and remodel it and turn it into an investment property. So, and it's fun. I've done a lot of fix and flips. They're great. They're a lot of fun. Things go wrong. You get into something and find out, oh man, the roof's leaking or the appliances need to be fixed or problems with the home or, that kind of thing. But they can be an investment as much as they can be anything else. Let's see. Is it bad to buy a 30-year-old home? That really depends. I mean, I've seen homes that are 30 years old that are just rock solid, and I've seen some that are 5 years old that are falling apart. So generally speaking, I would say some of the older homes, any issues that have come up have usually been resolved. If there was a foundation issue or that type of thing. Now, at the 30-year mark, you are going to run into issues with maybe the appliances at the end of their life, the roof at the end of their life. So you're definitely going to be at the end of the lifespan on certain things. But amazing benefits can come from things that have been repaired up to that particular point. You also usually have maturity with landscaping and neighborhoods more established. And so, I mean, the answer in real estate a lot of times is it depends. Depends on where it's at. Depends on what condition it's in. Depends on many other factors. But just to say it's 30-year-old make it bad or good, it really just depends on the house. It really does. All right, let's see. What's the catch with a cash house buyer? I don't know what the catch would be. Again, it just depends on what's the catch with a cash home buyer? There's a catch. Why is it different? So let's say you have selling a house for $400,000. If the person's getting a loan or giving you cash, you're still getting the same $400,000. There's no catch. I don't know. That's an interesting one. Don't know. All right, let's see. What else here? Let's go. Let's see. What are the pros and cons of an FHA loan compared to other loans like VA or conventional loans when buying a home? So with a VA loan is a veteran loan. It's the best loan on the planet. I'll put it up against any other loan. It's 100% financing. There's no mortgage insurance on it. It's one of the better loan. It's the best loan out there. So you can't get a VA loan without being a veteran. But if you can get a VA loan, do it. Do it. There's no reason to do a conventional loan over a VA loan if you have the eligibility. FHA versus conventional, those are where they differ. FHA loans have mortgage insurance that's the same regardless of your credit score. So if you have a higher credit score, conventional loans can be cheaper on the mortgage insurance. So for instance, if you're down in the 600, lower 600s, FHA can be cheaper because the mortgage insurance is cheaper. If you're over that, like 680, 700 scores, you don't have to pay quite as high on the mortgage insurance, which means the conventional loans can be a little bit better. Guidelines can be a little different. Underwriting guidelines can be a little bit different, a little looser and a little stricter depending on your situation. But they both have a need. They both are fitting a need within the marketplace. And they both have benefits and disadvantages. So it really depends on your situation. That's where, when talking with a lender, they should be able to review, okay, here's how a conventional loan works for you. Here's how a conventional or an FHA loan works, and show you the difference. Conventional loans do have loans that only require 3% down, but most conventional loans are 5% down, where FHA is only 3.5%. So it will be usually less money down on FHA and can be a cheaper payment with lower credit scores. So that's really the biggest difference between those two programs. Let's see what else we got. Maybe we'll do another FHA question here. Let's see. Who pays the closing costs when purchasing a home with the FHA or VA loan in the United States? So closing costs are always on top of the loan. Now, VA has a funding fee and FHA has a upfront mortgage insurance fee they add on top of the loan. But that's the only fee they're adding on top of the loan. All the other fees associated with it, the appraisal, title fees, origination charges, processing, underwriting, are always on top of that. They're not rolled into the loan. The best way to do it is to include it in the sales price. So let's say it's a $400,000 home. You can say, okay, I'll give you $405,000 if you give me back $5,000 to help cover the closing costs. So that's the way you can do it. That's the cheapest way to do it, besides building into rate or other factors. So that's usually what I tell my clients to do. Instead of negotiating maybe the price down, just get more for the price. Include the closing costs so you only have to bring your down payment. But if you don't have that built into the price, you have to factor in down payment plus closing costs on every loan, whether it's FHA, conventional, VA. Those loan fees are added on top of the loan balance. And the only way to get rid of it is paying cash, building into the sales price, or raising the rate. So you can raise the interest rate to get a credit back to cover that, but then that's a higher interest rate, higher payment, and that's for the life of that loan. Where if you build it into the price, that's the cheapest way to do it, is build it into the actual price of the home. Now, if it doesn't appraise for that, you'll have to deal with that. So say it's $400,000 as the sales price and you raise it to 405 or 410. If it doesn't appraise for 410, then that's when you have to renegotiate, or then it's when you have to bring the money in. But there's really no way to roll the costs into the loan on a mortgage. Let's see. What is the average approval rate for FHA mortgages in California and Florida right now? What factors affect this stat? Now, that's a good question. Approval rate, here's the tricky part. Most of the time, it doesn't get to an underwriter without it being at least approvable, because we run it through automated systems to kind of make sure that it's even worth doing a pre-approval. So very rarely are you going to, I don't think they have a high unapproval rate because it doesn't get that far without knowing it's likely to be approved. I'm sure obviously it does. So if you submit a loan application and something changes or it doesn't match up to the actual documentation, let's say on the application you say you make 10 grand a month and you only make 9,410, something like that, then that changes that approval and that probably denies the loan. But I have to check into that. I don't think there's a huge denial rate because it doesn't get far enough to even get denied if it doesn't have a chance to get approved. So it's much more on the front end. A lot more of the work's done on the front end before it even gets to the point where it gets to an underwriter. Especially if you're doing your job. If you're getting it all the way to the underwriter without knowing that you've got a 99% chance of getting it done, then you'll have appraisal maybe come in wrong, or there'll be something, or job change, or credit, something will pop up on credit, and that denies the loan. But generally speaking, it doesn't get to an underwriter. It's more the underwriters making sure it all fits and making sure the numbers match. But so much more of the work's done on the front end with processing, loan officers. We have a pretty good idea whether that loan's going to go through or not, to not waste the time of an underwriter or the client or the agent or the seller. So much more of the work's really done on the pre-approval stage, and that's where it should be done. All right, how are we doing on time? Let's see. Oh, man. Okay. Let's see what else we got here. Can you top off a home loan from another bank? Can you top up? Can you top up a home loan from another bank? Okay. How soon can you buy a house? How soon after you buy a house can you sell it? There is no rule that says you can't sell it the day after you buy it. There really isn't. But if you do a traditional loan, most loans are designed to have a recapture fee if you don't keep it at least 6 months. So if your intention is to just flip that home, buy it, and sell it right off the bat, and you're getting a loan, you really want to talk to your loan officer first, because you want to do the right type of loan. You want it to be more of a short-term loan, not a long-term 30-year fixed, traditional securitized type mortgage loan. That means the rates are going to be worse. The whole reason they're offering these interest rates is the security. It's supposed to be more long-term. That's why you're getting the rates that you're doing. But if you're just going to flip that thing day one, then there's different types of loans that you want to talk about. It really is something where that's a bad call for a loan officer. You talk to any loan officer that has had a recapture, or somebody, they do a loan, they spend a month getting the paperwork together, they get it all closed, they get their commission, all of a sudden, bam, their commission's due back, or they have to pay back the loan, or that's a bad phone call, especially when you know that person probably had the intention at the beginning, just didn't tell you. But if you're paying cash for a home, or you're just buying it and you just want to sell it, you can sell it literally the next day. There's nothing that prevents you from that. Now, some lenders are going to want to know why you're bought it for $200,000, now you're selling it for $3 million. They're going to want to do some checks on the title work. So there is some checks on that to make sure it's not a property flipping scheme or something where somebody's trying to buy and sell, buy and sell, buy and sell, and kind of change the market value of the home to be able to show all these sells. I mean, there's some fraud out there that happens with flipping schemes. But the short answer here is how soon after you buy a home can you sell it? Same day. You can literally sell it the same day. But if you're doing a loan, please tell your loan officer that that's my intention, is not to keep it. So that way they do the right type of loan for you. That would be, yes, just talk to your loan officer. All right, let's do one more. Let's see, what do we got? We got 20 minutes here, just over 20 minutes. Let's do one more. I hope you're enjoying these. I've done a bunch of them. If you have questions, comments, please put them down below. I'd love to answer your questions as well. Let's go. Let's see. What should buyers know about purchasing a home during a seller's market? So there's the talk of a seller's and buyer's market. Basically what that means is if we had the same number of homes on the market and we kept the same number of sales each month, when would we run out of homes? So let's say there's 1,500 homes on the market and the average is 250 a month being sold. We would run out of homes in 6 months. So 1,500 divided by 250, we'd run out of homes in 6 months. So when you're less than a 6-month supply, you're typically a buyer's market or seller's market, excuse me. That means there's more buyers trying to buy a smaller amount of homes. So the competition for buyers is higher. When you have more than 6 months, you have what's known as a buyer's market, meaning you've got a lot more sellers and there's only a couple buyers. So these buyers are only attracted by the lower price or amenities or stuff like that. So that's kind of how that buyer's and seller's market ebbs and flows. Now, for the last couple of years, most markets have been a crazy seller's market. Whenever you get less than 3 months, that's when it gets a little out of balance. You really want it to be between 4 to 6 months, kind of in that magic range. So whenever you get to the point where you've only got 1,000 homes and you're selling 500 homes every single month, you're running out of inventory way too quick. And when you start running out of inventory, whether it's houses, cars, boats, paper, pencils, the price goes up because you have less to sell and too much demand. So it's something where it's a really simple supply and demand type calculation. With housing, that's really what they look at. Buyer's market is when it's less than or more than 6 months supply. Seller's market when it's less than 6 months. Now, some markets might be a little bit different than that, but that's a general rule of when you're kind of switching from one market to the next. So what should buyers know about purchasing a home during a seller's market? Know that usually that means the price of the home is a little bit more. But when you also get a high seller's market, that usually means the demand for the area, the attractiveness of the area, the subdivision, the demand for jobs. There's something else that's making that market exciting for buyers to move into. There's opportunity, there's growth, there's schools, there's other things that make it worth maybe paying a little bit more for that particular home. When you had a combination of really, really low interest rates and really, really low inventory, that's really what spiked it up to probably the strongest seller's market we've ever seen. And we wanted it to correct. And it's starting to. The issue we want is we just don't want the door to just completely fling the other way. That's when you get problems, whether it's a stock or a bond or houses. You just don't want those crazy spikes because usually it's more emotion at one point. It kind of ticks up to here and then the next 20% is all emotion. And that's the part that starts hurting people, that it isn't really what's happening. It's all emotion and reaction. But I think we're seeing that it is starting to go a little bit back more towards whatever our normal market is. But because it's changing, the news and the cycles just keep saying it's crashing, which it really isn't. It really isn't. It's not the '08. It's not people running to get foreclosed on. It's not people just walking away from their houses. It's not easy financing. Most people put the extra money down because they saw the value of leaving the area they were coming from or moving to a certain area. Most people started being able to work remotely so they could live anywhere they wanted and still earn the income that they wanted to. So tons of opportunity opened up, which also drove people to other markets, which the markets just weren't ready for. They just weren't ready for the growth in some of these areas. But so what's something to buy? Your house payments are what really matters. Yet maybe you bought the home for a little bit more than what it's really worth, but over time, it's going to be worth more. If you look at the last 30 years, homes are up 300%, even with the 2008 correction. So even if you bought it at the high of the market, as long as you're more thinking long-term, a little longer term than you were maybe a few years ago, you're still going to have a housing expense. So why not own it? you're still going to have appreciation. You're still going to have tax benefits. You're going to still see the pride of home ownership. I know people are really worried about buying at the wrong time in the market, which is impossible to time anyway. You're still going to have a housing expense. You're still going to make out in the long run. I guarantee you're going to make out in the long run. Now, maybe you got to keep it a year longer than you thought. Maybe you won't make as much as people were making 2 years ago, but it'll come back. It'll come back in a huge, there'll be another big wave where homes will go up 5% in a year again. But they're not supposed to go up that much. They are going up. They're supposed to, but whenever there's that big spike, there's supposed to be a little bit of a slowdown, and that's fine. That's natural. It's natural. Even the worst housing correction in history was recovered within years. And you still have a housing payment, and a housing payment on a mortgage is much more locked in than rental. That's 110% interest when you think about it. So buy a house. If you can buy a house, buy one. I guarantee if you buy one now, 2 or 3 years from now, you will not be in worse shape. You won't. Now, don't overextend, obviously. Don't try to do a $5,000 house payment if you can only afford $2,000. But if you can afford $2,500, go find a house that fits that budget. There is one in the market now that there wasn't even a year ago. So that's the thing to look at. People are like, well, my $2,500 doesn't go as far as it used to. But now there is usually more homes to choose from than there was before. And if there isn't, they're coming online. Home value, land's coming down a little bit. The cost of materials has come down a little bit. So there will be more opportunities to buy. So figure out your budget, talk with a lender, get pre-approved, and say, okay, I can afford $2,500 a month. Go find a house that's $2,500 a month. You'll be better off. You will be better off. I believe in real estate. Well, soapbox. This was a soapbox issue. I'll have to review this video, but I got on some soapboxes today. But I love real estate. I love what I do for a living. I love help people buying and selling homes. If you are looking to buy in Utah or Nevada, I'd love the opportunity to work with you. I've been doing this for years, and love the opportunity to work with you. That's why I do the videos. That's why I try to show my passion and excitement for this industry, and would love an opportunity to work with you. So check out my website at ryanbolton.com. You can apply right there. Call me. You can set up a schedule we can meet at my office. We can meet over the phone, Zoom calls, all those fun things. So hope you have a wonderful day, and look forward to seeing you next time.